Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us discuss now one question on retirement of partner where continuing partners' capitals are adjusted in new profit sharing ratio and adjustment is made in cash. How to give all these accounting treatments? Let us discuss in this question. Let us go through the question. Following is the balance sheet of Meenakshi, Sunita, Ritu, who were sharing profits and losses in proportion to their capitals. Capitals of Meenakshi 50,000, Sunita 20,000, Ritu 30,000. Capital of Meenakshi 50,000, capital of Sunita 20,000, capital of Ritu 30,000. If we remove all zeros, it is 5:2:3. This is their capital ratio. Same will be their profit sharing ratio. They have given creditors 15,000. Asset side we have plant machinery, land building, stock, debtors less RDD and cash balance. Ritu retires. So among these three, Ritu is retired from business on 31st March 2012. Ritu retires from business on 31st March and the following adjustments were agreed. The stock is valued at 92% of its book value. So this is an adjustment on stock. RDD is to be maintained at 10% of debtors. Debtors are 12,000. So actual RDD required is 12,000 multiplied by 10%. That is 1,200. Cash 17,000. Ritu retires from business and the following adjustments were agreed. The value of land and building is to be appreciated by 20%. Land and building is 55,000. They are saying 20% appreciation. So it will be 11,000. The goodwill of the firm be fixed at 12,000. And Ritu's share in the same is adjusted in account of continuing partners in gain ratio. So we are required to do adjustment working note for this particular adjustment. The entire capital of new firm be fixed at 1,60,000. That is capital of new firm where continuing partners will be members between Meenakshi and Sunita in proportion to their new profit sharing ratio, which is 3:1. This ratio 3:1 will be used for fixing the capital and its distribution as well as for calculation of gain ratio. By making adjustment for difference in cash, prepare profit and loss adjustment account, partners capital account, third balance sheet after retirement of Ritu. In addition to this, we will be preparing cash account to understand the movement of cash. let us first calculate gain ratio. What is gain ratio? Continuing partners, they gain because of retirement of one of the partner, because retiring partners profit share will be in future enjoyed by the continuing partners. So gain means a increase in share of continuing partner due to retirement of one of the partner. Formula is gain ratio is equal to, we are required to find out gain share, that is new share minus old share. Here Meenakshi's gain share we can calculate. Her new share is 3/4, old share is 5/10. So gain share we are getting here 10/40. In case of Sunita, her new share is 1/4, old is 2/10. We are getting gain share 2/40. So gain ratio of Meenakshi and Sunita is 10/40 is to 2/40. That is 10:2. This can be simplified as 5:1. So we got gain ratio 5:1. The goodwill of the firm to be fixed at 12,000 and Ritu's share in the same be adjusted in accounts of continuing partners in gain ratio. Firm's goodwill is rupees 12,000. Ritu's share in firm's goodwill is equal to firm's goodwill multiplied by Ritu's profit share, that is 12,000 multiplied by 3/10. So here we are getting Ritu's share rupees 3,600. This will be divided among continuing partners in gain ratio. That gain ratio we have calculated here 5:1. Meenakshi's capital account debit 3,000. Sunita's capital account debit 600. That is, it is divided in the ratio of 5:1. To Ritu's capital account 3,600. New firm's capital, it is fixed at 1,60,000 between Meenakshi and Sunita. Meenakshi's new capital will be total capital multiplied by her new profit share. 1,60,000 multiplied by 3/4 will be 1,20,000. Sunita's new capital Total capital 1,60,000. Sunita's new profit share 1/4. It will be 40,000. These new capitals will be appearing in new balance sheet on liability side, and on debit side of partners capital account we are required to show them as two balance carried down. Asset side we have plant and machinery. Amount is 20,000. There is no adjustment on plant and machinery, so it will be recorded in new balance sheet on asset side as it is. New balance sheet asset side plant and machinery 20,000. Land and building 55,000. There is adjustment on land and building, so it will be recorded in new balance sheet in inner column. New balance sheet asset side land and building 55,000. Stock 12,000. There is adjustment on stock. Stock 12,000. Debtors, there is adjustment on RDD. Inner column 12,000. Current RDD is 1,000 rupees. Debtors 12,000. Cash 17,000. We have open cash account. This amount will be transferred to the debit of cash account. Cash account debit side to balance brought down 17,000. Liability side we have capital of Meenakshi, Sunita, Ritu. It will be transferred to credit of their respective capital accounts. Partners capital account credit by balance brought down Meenakshi 50,000, Sunita 20,000, Ritu 30,000. Creditors 15,000. There is no change in amount of creditors, so it will be transferred to new balance sheet as it is. We have done necessary transfers. Let us proceed to solve adjustments. Ritu retires from business on 31st March 2012 and the following adjustments were agreed. Stock is to be valued at 92% of its book value. Here we have stock 12,000. Stock is 12,000. Revised value is 92%, that is 11,040. Stock has gone down by 960. This will be recorded then to the debit of profit and loss adjustment account. Profit and loss adjustment account debit to stock 960. RDD is to be maintained at 10% of debtors. Here we have debtors 12,000. 10% means it will be 1,200. Current RDD is 1,000. So we are required to increase it by 200. It will have one effect to the debit of profit and loss adjustment account. Profit and loss adjustment account debit to RDD 200. It will have another effect in balance sheet. New balance sheet asset side, debtors we have 12,000. RDD required is 10%, that is 1,200. Already we have RDD 1,000. It will be increased by rupees 200. So net debtors are 10,800. Next, the value of land and building is appreciated by 20%. Land and building we have 55,000. 20% means it is rupees 11,000. It will be credited to profit and loss adjustment account. Profit and loss adjustment account credit by land and building 11,000. In balance sheet on asset side, we are having land and building 55,000. To this we are required to add this amount. It is added to the amount of land and building. 20% increase, amount is 11,000. New value of land and building 66,000. Goodwill of the firm fixed at rupees 12,000, and Ritu's share in the same be adjusted in account of continuing partners in gain ratio. We already done this working note. Let us go through it. Firm's goodwill 12,000, Ritu's share 3,600. It is distributed among Meenakshi and Sunita in the ratio of their gain, that is 5:1. Meenakshi's capital account debit 3,000, Sunita's capital account debit 600 to Ritu's capital account 3,600. This will be posted to their capital accounts. Partners capital account debit Meenakshi, Sunita to Ritu's capital account 3,600. Here on credit side in Ritu's column, by Meenakshi's capital account 3,000, by Sunita's capital account 600. The entire capital of new firm to be fixed at 1,60,000 between Meenakshi and Sunita in proportion to their new profit sharing ratio, which is fixed at 3:1, by making adjustment for difference in cash. We have prepared working note to calculate new capitals. Combined capital is 1,60,000. It will be divided between Meenakshi and Sunita in their new profit sharing ratio 3:1. Meenakshi's share 1,20,000, Sunita's share 40,000. These capitals will be recorded in new balance sheet on liability side. New balance sheet liability side, capital Meenakshi 1,20,000, Sunita 40,000. This will have another effect to the debit of their capital accounts. Partners capital account debit side, in column of Meenakshi and Sunita, to balance carried down. These are their new capitals. Now we can proceed to close profit and loss adjustment account first. We have closed profit and loss adjustment account. We got balancing figure on debit side 9,840. This amount of profit is distributed between Meenakshi, Sunita, Ritu in the ratio of 5:2:3. Meenakshi's share 4,920, Sunita 1,968 and Ritu 2,952. This will be transferred to their respective capital accounts on credit side. partners capital account credit by profit and loss adjustment account, that is transfer of profit. Meenakshi 4,920, Sunita 1,968, Ritu 2,952. Let us close now partners capitals. We have closed Ritu's capital account. It is showing balance 36,552 payable to her. It is transferred to Ritu's loan account. We have closed Meenakshi's capital account. It is showing balancing figure on credit side 68,080. That is a difference of cash she will have to bring to match her new capital of 1,20,000. We have closed Sunita's capital account. It is showing balancing figure on credit side 18,632. To match her new capital 40,000, she is required to bring this much amount of cash. These two will be then recorded in cash account on debit side. Cash account debit side to Meenakshi's capital account 68,080, to Sunita's capital account 18,632. Now we can close cash account. We have closed cash account. It is showing balance 1,03,712. This will be transferred to new balance sheet on asset side. Asset side cash 1,03,712. On liability side, we are required to disclose amount payable to Ritu, that is Ritu's loan account. Ritu's loan account is 36,552. Balance sheet liability side, we have recorded Ritu's loan account 36,552. Let us close now balance sheet. We have closed balance sheet. Asset side total is 2,11,552. It is equal to liability side total, that is 2,11,552. So balance sheet is tally. In this question, we learn how to do adjustments relating to new capitals fixed by continuing firm based on new profit sharing ratio. Thanks for watching this video. Stay tuned with Ekeeda and subscribe to our channel Ekeeda. Thank you.